But what I want to get into is, I want to show you a quick video we did, and I've got this video on YouTube. You all can watch it. It's something that I learned by reading a book, and it was a very boring book. It was a book called How Privatized Banking Really Works. It's about economics and all that dry stuff. It took me a month to get through this tiny little book because it was just terrible. But at the very end of the book, it gave me the golden nugget. And that's sometimes all you need out of a book. It's just that one idea. And it gave me this idea because, I pay a lot in taxes and I don't like paying taxes. So I'm always looking for ways to use the legal system, the tax code, to get additional write-offs. And I found this write-off, and seeing as though I like cars, I did this. So let me play this video. Some of you may have seen this, but if you like what is in this, I got two things for you folks. This weekend, we've got the Money Multiplier Advanced Privatized Banking Training. It's Saturday, Sunday. It's a whopping $50 for both days. And we literally have come up with an entirely new agenda on what we're going to teach. It's personal uses and business uses on everything from how you can use privatized banking to, get tax write-offs for your company and make a whole bunch of money, but advanced things, all advanced techniques and advanced strategies. And that's going on this weekend. I'll be putting the link throughout. So if you guys want to see it, but one of the things we're going to be teaching is this strategy here. So I'm going to share my screen. We're going to play a 1 minute long video, and then we're going to jump right into this, folks, and we're going to have some fun because we're going to be talking about executive benefits and all sorts of amazing stuff. Brian is going to rock your world today. But before that, let's just watch this quick little video.
How would you like to drive this as your company car? However, your private bank gets paid for it. But once you start driving it, you really start to understand some of those things like the sound. It's that race car sound that you get driving one of these 6,000 plus pound vehicles. I mean, you can't really pay too much for that. Doesn't that make sense, Cash? Cash is king. So I just bought a Mercedes, commonly called a G-Wagon. And the best part about it is I get paid to drive this truck. To make this work, I use my own privatized bank with the Money Multiplier. And if you don't have your own privatized bank or even know what that is, you're going to want one by the time this is done.
All right, so there it is. Super short, super sweet. And that's the video, but there's a full training on YouTube all about
if you want to know
all about that video there. Let me get rid of this and unshare my screen. So that technique right there, that strategy of getting paid to drive a company car was one I've never heard. Kind of something I knew about, but we all, business owners often lease cars because they want obviously the tax write-off. And then a lot of business owners buy heavy vehicles because they can use that tax code to get the write-off in the first year, or 25,000 of that write-off for an SUV. So there's some interesting things. So check out the YouTube video if you want to see that, and how to actually get paid to drive company vehicles. And gets even better, get all the money back for every vehicle you ever buy, drive, and own. So Brian, welcome back to the Wealth Webinar Series.
Thank you, Chris. I appreciate that, and I enjoyed the video also.
You should see the full training. The full training came out really good. So we I don't know, we got this thing where we spend just a silly amount of money producing those videos, and man, we got wrapped up in that one because I was so excited about it. But I'm also excited about what you're going to be talking about today, because we're going to be talking about some business uses, executive benefits, and we just did, I don't remember how many weeks ago it was, but we had you on talking about long-term care and that patented product, asset care, and man, oh man, like, what a hit. I have literally gotten more emails from people saying they enjoyed that and they were really happy and it was really timely. I couldn't even believe it. I mean, I'm always thinking, all right, long-term care, boring, but you know what? Doesn't matter how boring something is. If it solves someone's problem at the right time in the right place, there's nothing boring about anything. So you knocked it out of the park with that. And today I think you're going to do the same thing. So the stage is yours. This is your day. So I'm just here to support you. I'm here to answer your questions. Where should we go from here?
Well, I appreciate that, and I think what everyone will enjoy today, hopefully, is that first go around is about a month ago. We talked about long-term care, and more specifically, we talked about asset-based long-term care and how significantly different that strategy or that product slash tool is different than the dinosaurs of long-term care. And anyone who was on that or watched the recording really got a lot out of that. There were a number of questions that people had that related to the business use, tax deductibility of premiums for long-term care, how you can use it if you're an S Corp or a C Corp or an LLC or a sole proprietor, or just somebody out there that's just trying to do some real estate stuff. So, so I put together a little bit of a PowerPoint, and let me give you the backdrop here a little bit. And here are 3 or 4 things that I always say to people. Interestingly, Chris's backdrop is one of them, which was not staged. I have no idea why he wrote that thing that back there on the whiteboard, but I say it this way: if you believe something that was not true, when would you want to know about it? And then I also say the insurance industry manufactures products that really can fix just about any particular person's financial problem. Unfortunately, the insurance industry for 300 years, though, has been teaching people to sell insurance in a way that kind of irritates people or pisses them off, to be blunt. And then they scratch their head trying to figure out why more people don't use insurance products. And I'm going into this a little bit with this backdrop, Chris, that first of all, if you believe marginal income tax rates are going to be higher in the future than they are today, then there's absolutely nothing out there in a qualified plan that you should be using. And what I mean by that is, why would you defer paying your taxes today so you can pay more taxes later on down the road? And everything here at the Money Multiplier that you guys hear is not the conventional wisdom, is not what the normal financial advisors are out there are talking about, and nor should you be listening to it. So you also know that I am not a sophisticated confusion guy. I try to live my life in mature simplicity. I don't consider myself very technical. But today's topic, we're gonna need to get into the weeds a little bit. I apologize up front. I will try not to get into sophisticated confusion. And there may be some questions on some different slide information, if you will. And if we can answer them today, great. But it's probably gonna be better if there's a one-on-one with me afterwards, whether it be an email or a phone call or a Zoom meeting. We can kind of dive into some of the weeds or drinking from the fire hose, if you will. So, Chris, with all of that said, did that spark anything on the top of your head?
I mean, it always sparks things in the top of my head. I just want to learn. I want to learn how this stuff can work, not just for, the people on this training today, but also, I'm constantly learning to apply and find new things. I mean, from the long-term care side, I'm very much in love with that product. I pay for my mom's long-term care, but I'm sad to say I don't have long-term care. And that's a freaking problem. I mean, I might be, young in my mind, but I'm 43. Like, come on, Chris, it's time to go. The time is now. So that's my thought.
Yeah. Yeah. Well, let me do this. I think I have the ability to share my screen. Is that correct, Chris?
Oh yeah, you do. Mm-hmm.
Okay. All right. So I'm going to share my screen, and hopefully I'm not I'm not the most technical guy in the world. So hopefully this works. And are we working?
You got it. Yep.
All right. I even managed to type in that label for the slide, Wednesday.
Holy smokes. Man, see, you can't say that you're not good with this tech stuff. You just typed on a computer, man. Like, think of that.
Let me give everybody the backdrop again. I'm a huge fan of that tower, the One America Tower in Indianapolis, Indiana, and they are just one of those really good insurance carriers out there in the United States of America that nobody's ever heard of. And I always kid around and say, well, that's just because they don't advertise during the Masters. But One America really was way ahead of the game. They invented and patented a product almost 32 years ago called asset-based long-term care. And it's not the dinosaur that people think of, because nobody wants to talk about long-term care, mortality, morbidity. The reason is because we're all perfectly healthy, psychologically well-adjusted human beings, which means we're in total denial of our mortality. That's a good thing because it allows us to function as members of society. So today I'm going to twist the asset-based long-term care a little bit on its head and talk with everyone about how to use this stuff in business, and then how to write it off on your taxes and how to get some deductibility. And then in addition to that, for the people that are on today that own businesses, then we can show you how to use this as an executive benefit to tie in your key man or key woman employee. And if you're not a business, then maybe you're going to become a business owner, and then you'll be able to use it. So I guess there's maybe there's a time for Q&A, but Chris, if something pops up on your end, because I'm not going to be able to see all that stuff going on, then just jump in, interrupt me, and we'll try to take them as we roll. How's that sound?
Will do. Yep, we got 2 questions so far, which we'll make sure Eve and Anonymous have questions up, but both of them we'll get as we get going here, and I'll try to answer anyone's questions. So anyone that has questions, if you could do me a favor, just put them in the Q&A. I'm going to try to keep up with the chats, but with 101 people, it's just impossible to really stay on top of it. So if you have any questions, put them in the Q&A. We will answer every single one of them. And Brian, I'll just kind of sit back here. I'll go on mute and I'll just type away for you.
Okay, sounds good. All right, guys. So again, the little bit of the backdrop, you got to understand the strategy and you got to understand the product a little bit. So the first maybe 4 or 5 slides, I'm going to hit that, and then we'll get into the strategy of how to use this stuff and get tax write-offs and stuff like that. So first of all, qualified long-term care insurance. Got to go all the way back to HIPAA 1996. And these slides are packed with information, so I'm just going to hit the high notes. But HIPAA says, hey, it's got to be a qualified long-term care. It's got to be guaranteed, and it's got to have refunds, and it's not reimbursed with Medicare, and there's some triggers and all of that stuff. That's just really One America going to the IRC tax code and then designing a product that is actually going to work in the IRC eyes, if you will. The best thing about the asset-based long-term care product through One America is it is a life insurance policy. It is a whole life insurance policy, and it provides long-term care benefits. So understand that someone's getting the money. It's not the dinosaur of long-term care where nobody got anything if nothing ever happened to someone. So how life insurance with long-term care benefits works, it's simple. Again, cash value accumulates or tax deferred. Let me keep things very, very simple. Permanent life insurance and a Roth IRA are identical. You put after-tax money in, it all grows tax deferred, and you can take it back all out tax-free. Funds are available through withdrawals or loans. There's death benefit that gets accelerated, and the remaining death benefit will get paid to a beneficiary, again, tax-free. Life insurance-based long-term care, how do you fund this stuff? How's the strategy? Take your pick. You can pay it over a 5-year. Chris, you're 43. You want to pay it and be done at 53? You can do a 10 pay. You can do a 20 pay. You can continuously pay premiums till you're 95. You can take a couple $100,000 out of a CD, hand it to One America and say, I'm never giving you any more money. I did it one time and I'm done. How about the transfer of after-tax surrender proceeds from existing annuities, IRAs, qualified money? Phenomenal concept. Use IRA money out there that you really don't need, and you don't want to have to pay taxes on a huge distribution. Simply roll it over and fund your asset-based long-term care all at one time. And again, I mentioned CDs and other stuff. So there's many, many different ways to design this strategy. Lifetime protection, premiums that cannot increase. Everything about the strategy is guaranteed. Premiums never go up, benefits never go down. They can't cancel you. There's inflation protection if you want it. And again, because it's sitting on a foundation of whole life insurance, again, everything's guaranteed. This just popped into my head, so I'll just share it. Waiver of premium. If anyone goes under claim, you don't pay the premiums anymore. Even if you're using IRA money, they just send you the money. So the IRC Section 162 is the area of the IRC tax code that talks about businesses and the desire to retain and or reward key employees. So it's your right hand, you're the CEO and you don't want to lose one of your employees that have been with you for a long time. So you want to retain them. Section 162, it's a bad word, but you actually can discriminate, meaning if you have a business and you have 50 employees and you have 2 or 3 really, really important employees, then you can do something for those 2 or 3 that you don't have to do for the other 47 or 48 people. And we can design these things so you can reward those types of people. It's not like the 401k, the IRA, the simple, the SEP, all of that stuff that, by the way, the government created. Therefore, make no mistake about it, there's a lot of benefit in the 401k plans and those things for the government. So how it works is simple. You have an agreement you put together with an additional benefit for an employee. It's tax deductible funds. The bonus to the key employee may actually become a double bonus because it does provide income for the employee. And therefore, as the employer, you actually may even want to bonus them a little bit more to handle taxes. It's a life insurance policy and it includes long-term care benefits. Let me say it this way. And people that have met with me so far have heard me say this. This is by far, hands down, the best long-term care policy in the country. There's no other company that pays lifetime benefits. There's no other company that allows you to use IRA money. It's not too good to be true. They've just only been around for 30 years doing it, and you don't see them again on the masters. Here it is in a diagram form. Employer establishes an agreement with an employee. That is a life insurance policy that provides long-term care benefits. The premiums are paid by the employer, and that is a taxable amount of income to the employee, but it is a tax deduction for the company. Okay? And from an income standpoint, if the employer wants to, again, double bonus the employee, then they can do that simply through a cash bonus to assist in that additional income.
That is such, I don't mean to stop you, but that is such a big thing right now. I'm working with a company right now, a small publicly or privately held company. And when I explained that about the double bonus, like he was just like, wait a second, I can get an additional tax write-off for doing this for my employees. I think that's a fantastic way to do this. And normally I never really thought about that, but now in a day where people are really trying to maximize tax deductions because taxes aren't going down, that's a huge.
Yeah, perfect. Love it. And a little bit here before some questions kind of come rolling in. Again, this obviously can be designed individually. Literally, if you're an employer out there and you have 500 employees, you can do this for one person. Most people do not realize that commercially, if you will, that one of the number one consumers of life insurance, meaning corporations out there that own more life insurance on their employees than any other corporations. You'll love this money multiplier, people. Banks. Banks own more life insurance than any other companies in America. Let me say it this way. It's interesting that we teach people infinite banking, which is why we're so uniquely positioned to talk about asset-based long-term care, is the fact that banks put their money in insurance, and then other people out there that don't know Chris and the rest of our team we put our money in life insurance. So,
and I've got a video coming for YouTube. I hate to keep going back to YouTube, but that's just my go-all, or my go-to, if you will, all about that, about banks and how banks put their money in the complete opposite place they tell us to put our money. And you got to start thinking about it. If banks are putting all their money in this, why are they telling us to put our money in savings accounts, checking accounts, mutual funds, CDs, and all those? When you watch the video on YouTube and it's called Bully, B-O-L-I, you will understand that. So thanks for bringing that up, Brian.
yeah, no, that's great. For anyone out there that's going to ask this question, you know, I'm the employer and I pay these premiums over 5 or 10 years, and then the employee just one day walks in and says, I'm leaving. Sure, that can happen. Or we can put what is in the bottom right hand of the screen, and that is a restrictive or a controlled plan. And that's where if I'm the employer and Chris is my employee, what do I want? I want him to stay working with me for as long as I'm going to do this, or let's just say it's 10 years. So I put together a plan. He and I sign it, that he has a vesting schedule, and maybe he vests at 50% after 5 years, 75% after 8 years. And if he stays the entire 10, then he gets 100% of the plan. So those are just little restrictive control plans or endorsements that can just be added onto this plan to keep the employee working for the employer for as long as they want them there. Again, I don't like getting into the weeds, and I don't like when people feel like they're drinking from the fire hose. So again, if there are questions, bring them in, we'll get to them, but individualize this. This does need to be individualized a little bit. So aspects of continuation of benefit. Again, this strategy, or One America's product, pays lifetime. It never runs out. If you have a catastrophic health event and it doesn't kill you, and you live 20 years and you're getting $100 grand a year, well, that's $2 million. So they keep paying. It's after the base policy. It says it requires additional premium, but that's just how I build the product. It's always just one funding. And again, you can fund them in any different ways: single pay, 5 pay, 10 pay, 20 pay, anything you want. The tax treatment of the acceleration benefits and all of that is separate. So the employer, it falls again under the IRC tax code that it is medical coverage because it is care. Business entities. I chopped out about 10 slides because I'm not going to go into every sole proprietorship or partnership or limited liability company, S Corp, C Corp, nonprofit corporations. All of those different things are individualized, but you can utilize this strategy as a tax deduction in any one of those entities. Assumptions, long-term care coverage. There's a reason we get away with this, and it's not because we're breaking the law. It's just because that's how the IRS wrote the code. So long-term care coverage is qualified under HIPAA. Premiums can be paid by the employer. The policy is owned by the employer, or I'm sorry, the employee. And other than paying the premium, the employer really has no interest in the policy. And that's why they're able to do this strategy. I'm going to blow through. Remember, one product, two issues. It's a life insurance policy. So if you never use it, somebody gets paid a death benefit. If you do use it, you can't outlive or outspend the care. We've talked about how you fund it, all kinds of different ways. Section 1035 exchanges, people out there in the life insurance world, they understand that. You can withdraw, you can use annuities. You can use the bonus from the employer, dividends from a C corporation, or even loans from an employer at historically low rates. Again, nothing that the government says that you're not allowed to do here. More strategies on how to use this. District HSAs. Again, you get a tax deductibility up front by putting money in an HSA, and then you can use it again to pay for your long-term care and get another tax deduction. A little bit of a double dip there. Everything else on there I've already talked about. Tax deductibility of qualified long-term care insurance premiums. You get a tax deduction as an employer or employee, or even individuals. And the individuals, after our webinar a month ago, have learned a whole lot about what they can write off on that also. So key man insurance with long-term care. Again, this is why you do it. Death benefit retained by the employer, so it covers the cost of potentially losing a key employee. We're not going to get into split dollar because everybody's going to need a bottle of Advil if I go down that road. And, so we're just not going to do that.
It's definitely a dry topic, but it is, I just want to clarify, split dollar is something, if anyone was really serious about looking at kind of how the banks use it, that would be one of the concepts the banks apply for BOLI. So, we could hit that later, or we can, you could schedule a call with Brian and you can go into this ginormous pamphlet here about how all that works with split dollar. I just wanted to bring that up because it is a pretty fascinating thing, but I think people's eyes will roll back in their head if you cover it today.
Yeah, no doubt about it. And again, I left this slide in here because if you've never read the IRC tax code, which trust me, it's not a page turner by any means, but there's all kinds of different sections, and those sections are really where we find I don't want to say loopholes, but we find ways to be able to use this stuff that benefits us as an employee or an employer. And, again, we're not breaking any laws. This is just the way the IRC tax code's written. And we get to utilize that for our behalf. No different than going out and buying a 6,000 pound vehicle. I left this one in here just because a couple people asked about solo 401k plans and that kind of stuff. And life insurance is part of the 412 plan. It can increase deductions even more. So if you're out there looking if you're a one-man band or a small employer, then again, there's some additional benefits that we can design to be able to allow that.
Real quick on this, it's another one that'll roll people's heads, but I did a lot of this when I was an advisor, and we work with small, closely held companies that wanted to maximize the amount of their deductions above and beyond what they could get in a 401k. I mean, what are the new rules with the 412(v)(3)s? How much can someone put away tax deductible in their company?
So where I try to advise people is if you're small employer, the $56,000 through a SEP is really where you can maximize that, and then immediately convert it, by the way, to a Roth, and now it's out. So you get the tax deduction up front, and then you let it grow at the end of that year. All that money continues to grow tax-free throughout your life. That's really one of the ways that we would design that to go, Chris.
Okay, because I 412(e)(3), there's lots of different things within this section, but I remember I set up a veterinarian. He had a small practice, but the two vets, the owners made, they made close to $1 million a year, and they were getting destroyed in taxes. And if I'm not mistaken, we set up a 412(e)(3) using life insurance as the funding vehicle. And God, correct me if I'm wrong, but I swear we were able to deduct over $200,000 for those docs. Through this section. Right. Is that about right?
Yeah. And if you're you can see right in the middle of that slide, 100% deduction of your entire asset-based long-term care premiums.
Right.
Again, by wrapping it that way.
And David was just, questioning that, which is why I wanted to kind of go just one layer deep into this. I don't want to go all the way to the core of the onion, but, I wanted to hit that because, it is a way where you get 100% deduction for this, folks. Yep. Phenomenal.
Yep. And, hey, I got through that a lot easier than I thought it was going to go.
You did, but there's so much stuff in there that we can kind of, go back and talk about. There's lots of questions coming in, but, you did get through that pretty quick, but if you could go back just a few slides, let's just let's dive into this one section. Cause this stuff just, honest to God, just fascinating. Let's go here. Let's just kind of go a little deeper into this, the 401h, and there's lots of, not that you all need to, this is what Brian's good at, and this is where his expertise really comes into play. But, there's 409A plans, 457 plans, 457Bs, 457Fs. And you're probably all thinking, what the heck are all these things? These are just different IRS codes that allow for different deductions and different ways you can put money away, whether it be like you saw with the 412E3, but I mean, different ways you can put money away for retirement. But here, Brian, here's kind of the rabbit hole I want to just hit on, because I think it's so vitally important. And maybe this isn't the right slide, but it doesn't matter. Is people think, business owners think that, if they want to set up a retirement account, there's all these rules, if they set up a 401k for their company, then they've got matches, they've got to provide the same thing for every single employee. Maybe the employer's thinking, oh man, I wish there was just a way where I could put money away for myself, my executives that are really helping me drive the company, but not for everybody else. And if they look at the traditional sources like the 401ks and simple IRAs, oh no, it's the same for everybody. And oh, God forbid, the highly compensated benefit from putting more money in than the rest. But a lot of people are like, well, that's just what it is. I guess I got to do that. But then comes along the non-qualified deferred comp. And that allows people the freedom and flexibility to really benefit and give this benefit to the employees they want. They don't have to offer it to everybody. And they got lots of, some of these things have a maximum annual contribution of unlimited. 409As and the 457F plans, unlimited maximum annual contributions. So, if somebody's behind, they got a business and they've been so focused on their business, putting money away, that they didn't really plan for retirement, but now they're trying to plan, okay, well, how do I exit this? How do I actually retire someday? I can sell the business, but it's still probably not going to be enough. Where now they need to stuff a ton of money away, and there's not really any other sources, but now there is. Like, there was a mouthful. Sorry, I went on a tangent.
No, you're exactly right. And again, the business owners out there that I'm working with, they're understanding, hey, we're going to end up paying higher taxes later on than we're paying today. So let's pay our taxes today and shove as much money as we possibly can into the vehicles that Chris and I are talking about, and everyone else here at the Money Multiplier. And, there's no free lunch. You have to pay at some point in time, but later on down the road, when you're distributing money to yourself, it all happens in a tax-free environment.
Absolutely. And then just kind of looking at this slide, the medical expense plan, the 401h, can we just hit this one just a little bit deeper than we did? Because I think this is an important one to really hit on. So just this particular concept of what you were talking about and how this can be utilized for what we were talking about.
Instead of the 401?
Correct. Yes.
Yeah, obviously the medical expense account, if it can be attached to a pension plan, again, the tax-free reimbursement of expenses, and again, from the employer standpoint, it's 100% employer deduction. And there's really nothing else out there that is going to be able to provide that on the employer end than this plan. May not be perfect for every employer, but it just depends on the company and what the owners of the company really want to do.
Right. Now, would this work for, like when you say it wouldn't be appropriate for every company, but like what kind of a company would this be best for? Is it the corporate structure, S Corp, C Corp, LLC, or is it the size, or like who would this really be applicable for?
I think you're looking at this for businesses that are north of 25 employees and maybe even some up into the 50s. Would not recommend this for, the under 10 employee company. That's really where the non-qualified deferred comp plans or non-qualified bonus structure plans would fit into the smaller employers, Chris.
Perfect.
Yep.
Now, is there anything that is appropriate? Like, let's just say somebody's, you know, they got they set up an LLC, they got maybe 1 employee, 2 employees, or maybe it's just family owned, and, you know, they're making great money, but then they just don't know what to do from tax deductions or anything else. What would be appropriate for a small company?
Yep. Let me put us back eyeball to eyeball so we can kind of just have a conversation here.
Yeah,
So,
I tend to look at the slide and drill into those things a little too much. You're like, get these slides away from that guy.
you know, the mom and pop companies, the family owned companies, you know, out there, those are really where the life insurance and overfunding the life insurance policies work tremendously well. I would still write them into a key man policy. So you can deduct some of the premiums there. If they're, you know, the employees that are over the age of 35, because that's the starting point for the asset-based long-term care strategy that we're talking about. So it begins at 35 and goes all the way up to 75. So any employee that is getting around that area, and I think 40 is really the sweet spot to look at that strategy. That's really where, again, the 401k plan, the simple IRA plan, the traditional IRA plans, they're just not the answer because you can't shove enough money into them. You know, $6,500 a year is all you can put into a traditional IRA. So it's just not the answer. And especially if they're family owned, then what do you want? You want to make sure that what you've spent a lifetime accumulating is preserved, transferred within your family, and you give nothing to the government.
Yeah, and it's a slippery slope these days because, I mean, well, I mean, not that this is the first time this has ever happened, but we're in an environment right now where, you know, we want to maximize tax deductions today because we know, you know, that we need them. But moving forward in the future, we don't want to take deductions today and then pay higher taxes later. At least how I look at it is if taxes are almost certainly going to go up, which I think we can all agree that that's you know, carved in the stone now that taxes are going up. I don't care if it's capital gains or your normal income tax. If that's the case, then why would we want to put money into something today, get a deduction today at today's lower tax rates to take it out at a higher tax rate, which I loved your put money into a SEP, a simplified employee pension plan. You can get up to what, 56 grand into those nowadays?
Yep.
56 grand in, then you convert it to a Roth. Now, all of a sudden, what you've done is you've gotten, you know, you've gotten a bunch of benefits, and then you got the tax-free nature of the Roth once you do that. Sure, you had to pay the taxes, but you paid the taxes today. And it got, there's a lot of benefits and a lot of ways to do it. So what would you say are some things that can work today where we want our cake and we want to eat it too? So can we get tax deductions and not have to pay taxes someday?
Well, you just said it after I said it, and that's one of the areas that for the employer, for the people out there that are making some money and want to try to get as much put away, obviously through the door of the life insurance policy, it works. Doing a tremendous right now. You've got about another 4-year window where traditional 401k plans, traditional IRA plans can be converted over to Roth. No free lunch. You got to pay the taxes on the converting amount. But, you know, if you've got $1 million in a plan and can convert 200 of that each year over the next 4 or 5 years, then you end up getting, you know, 800 grand into an environment where you're never paying any more taxes. It can continue to grow throughout your life. And later on in life, you can take it out. And as anyone who I think we talked a little bit about the term provisional income a month ago, but distributions out of a Roth, distributions out of life insurance do not count as provisional income. Therefore, you pay no taxes on any of that. And the SEP IRA plan, very, very good because it's $56,000. You can get the tax deduction up front and then immediately convert it. And there's not a whole lot of growth in the first year. So that's certainly one of the ways to go.
Yeah. And one of the things that we do, I got a YouTube video on this as well. I got a YouTube video for this and that, but is, you know, using the life insurance vehicle, the privatized banking, you know, as a vehicle to fund a supplemental retirement. And, when I did it on I'd never done it on mine, but I did it on my 7th banking policy, and I do the trainings, and we're going to really hit this heavy this weekend, folks, at the advanced training on how you can use this concept. But, it blows my mind sometimes, when you set these private banking policies up, these specially designed whole lives, and, you're thinking about it, like it's only 4% plus the dividend. So maybe you're at 6%. Like that doesn't really get people super jazzed, when the markets are doing what they're doing today, and Bitcoin, except for today, when Bitcoin's actually, making people money, and they start thinking, wow, 6% is not great. But when you look at how much 6% grows to over time, let's call it 10, 20, 30 years, it's insane. Compound interest is something that even I, as an advisor back in the day, didn't understand, because it is simply just magical. And then the ability for you to use that money while you're actually building for your retirement. I mean, that 7th policy, it's a $30,000 premium deposit for 10 years. Then it drops 22 years after I start that thing. If I do nothing with the money, I just put it in there and leave it sit, provides me a $93,000 tax-free income for the rest of my life to the age of 100. And I got money left over. I literally can't even spend it all. That's nuts. It's like taking $3 million out for putting $1 million in, guaranteed, or almost guaranteed. Just sometimes this stuff is just so fascinating.
Yep, no doubt about it.
All right, so let's see. I'm going to get into some of these questions. If anyone has any questions at this point, send them in. This would be the point where we want to get as many of your questions answered. And a lot of people, Brian, I mean, I'm kind of looking through the messages. A ton of people have already spoken to you. Unanimous said, so should you start to pay taxes on your IRA and invest the balance? So I guess I'm not, Unanimous, if you could maybe rephrase that a little bit, it might be easier for us to answer that. But what are your thoughts on just that right out of the hole?
Yeah, if you're talking about, so start paying tax on the IRAs, invest the difference. You want to get everything over into the Roth area. If you believe marginal tax rates are going to be higher in the future, and you're doing the tax planning that you're doing regarding using permanent life insurance or asset-based long-term care or whatever it may be, then I think you're asking, should we be converting our IRA money and then having to pay the tax? And just make the math easy real quick. If you've got 100 grand in an IRA and you're going to convert that, and for conversation purposes, you got to pay 20% tax. So you're going to convert 120% is 20,000 bucks. You're going to have to write a check on that and pay the taxes on the conversion. But now you've got 100 grand over in a Roth, and now it's going to continue to grow in a tax-free environment, and you're never going to have to pay any more taxes. And I think that's what you're asking there. And if I answered it wrong, Anonymous, then fire me another one and clarify for me.
Yeah, and I think I would second that. I think that's what he's asking. He or she is asking it. When it's unanimous, we don't know. Like you got money in taxable, money that you have in retirement that you could take out and pay taxes on it today. Should you just let it ride? Which a lot of people are like, I don't want to pay taxes. Well, someday they're going to force you to pay taxes on it, and chances are tax rates will be higher. So it does, in some scenarios, many scenarios today, make sense to get some of that money out today, reposition it like you mentioned. The only thing I always tell people is, we can't give tax advice. So I love working with people's CPAs to say, hey, listen, how much could, Joe Schmo take out of his IRA and, not have to bump into a higher tax bracket? That's how I always look at it, is if we can take money out of that taxable event and not move into a higher tax rate, and then take those assets, those dollars, and put them in a tax-free environment that can grow and never have to pay tax on future growth. Listen, call me stupid, but that just seems like a logical thing to do. I don't know, but some people just don't want to pay taxes. I mean, people that have tons of gains in their investment accounts, they don't want to sell their stocks or their mutual funds because they're highly appreciated and they got to pay taxes. So the strategy, the solution, I always tell people, is great. You don't want to pay taxes. Here's what you do. Leave it in there when the stock market goes all the way down, and you look at how much you got in it, and then when it gets down below that, then you sell it, and now you got yourself a tax write-off. So you can have it one way or the other. You can keep the gains and pay the tax on it today at the lower tax rate, or you can just wait till it goes down, sell it at a loss, and then obviously I think you all know that we're joking a little bit about that, but like you don't want to do that. Let's see. So that's unanimous. We got Eve. So Eve is already working with you. She was mentioning in the email just that, she was trying to get in touch with you because she did her call. So I'll let you handle that when I send it to you, but I think she just needs a couple documents and then you can take on with that.
She's in that wonderful state of California.
Oh, lovely, lovely, lovely.
And yeah, they have 92 more requirements than any other state, but Eve, I'll get those to you.
Awesome. All right, David, I think I already answered this one, but David was saying the premiums are in two parts. There's a long-term care component and then a life insurance component. Are both parts of the premium tax deductible if done in some of those environments you talked about?
Well, if when we're talking about doing it from in a business standpoint, then yes, we can certainly get it where both sides can be a deductible because it's really a bonus to the employee. For if you're just talking about, David, on just an individual policy, if you will, then yeah, One America breaks it into two pieces so you can deduct the long-term care piece.
Perfect. And I'm glad this question came up because a lot of people ask this. If the life insurance death benefit goes to your beneficiary, will that money be taxed under the estate tax policy?
Okay. So here's the answer. This is how I've always said this. 99.999% of the time, life insurance death benefit is tax-free. Okay. Now, if again, not getting into giving tax advice or any of that stuff, but if you understand the term unified credit, then that's really where you're starting to talk about estate tax planning. And the unified credit today, I'll just use me and my wife. Let's call it 22 million bucks. I can shelter 11 million. My wife can shelter 11 million. So the two of us combined can shelter $22 million. So if our estate is, and we're just shy of that, by the way, that's a joke. Just shy of 22 million bucks. So as long as my estate's not worth more than that, I don't have an estate tax problem. But here's the problem. Under the current administration, they're talking about decreasing 22 million down to 3.5. So when you talk about life insurance becoming taxable, it's for the ultra high net worth people that if I own my policy and I have an estate tax problem and I die, they can take the death benefit, our wonderful government can take the death benefit, put it into my estate, and then tax my heirs on that money. For most of us out there in the world, life insurance will always transfer tax-free.
That was a really good explanation of that. I think, more than they bargained for out of that one. So that's that one. Then I understand that the money goes income tax free. Will that be estate tax free? So you kind of already answered that one. All right. Jose said, what do you recommend first with about 35,000 from a 401k account, a whole life insurance or a Roth? Okay. So yeah. So basically you're just kind of saying, should I put money into this whole life thing that I keep hearing about, this privatized banking, or should I put money into the Roth IRA?
Yeah. That's individualized a little bit of a question there. I don't know if you're married. I don't know if you have young kids. Is there a need for death benefit? Do you actually own any life insurance currently? Is that the only money ever going to go into that account also? Permanent life insurance, and I'll use the word whole term, whole life, which is one variation of permanent, but definitely the one that we recommend. There are about 7 or 8 other benefits that you get out of using a life insurance policy than a Roth IRA. You can take money out, you can put it back in. Can't do that with a Roth. There's definitely risk involved in a Roth where, as Chris eloquently put it, you're getting a guaranteed interest rate plus a dividend. Everything about that is guaranteed in the life insurance policy. So I don't know if I can give you just a straight recommendation that, hey, do A, don't do B, without knowing a little bit more about your individual situation.
Yeah, so that one's definitely a question that should result in a phone call, because once we know a few things about what's going on, like Brian just alluded, we can certainly kind of get you a little bit closer to which one would be the best place to go. I mean, easy answer is, oh, you should have both, but sometimes that's not appropriate and sometimes that's not feasible for somebody. So, just a little bit more info would allow, Brian or I to make that recommendation to you. You're very welcome. Let's see. Then we got April. How can I get this type of insurance policy started? Okay, well, that's easy, April. I just put up Brian's calendar. So you just click the calendar link, okay, right or left hand, and you just pick the day that works for you. And that's how you get that type of policy started right there. Okay, so we got through all those questions. Does anyone else have any questions? Let me ask a question to all of you. We got 94 of you left on here. So out of the 94 of you, how many of you are business owners with 2 or more employees? So if you guys could chat in and just, you could just raise your hand. You can just say, I am. How many of you are business owners with 2 or more employees? So I just want to see how many people come in and say that. And also, Stephen just posted, at 4:30 today, folks, we have our, we do it every week, but we have our happy hour, Ask Me Anything, where you guys can come and ask questions and we'll answer them. We'll have a ton of fun. It always goes a unique direction. So any of you that join us for the happy hours, you always know you're going to get a laugh, if nothing else. All right. So who else? Let's see. Co-owner of a business, no employees, just the 2 owners. Okay, great. Well, actually, let's see. So Gene has one. Yep. Okay. Herschel has a company with more than 1 or more than 2 employees. What if my employees are 1099? So in some of this stuff, that would be okay, right, Brian?
Yeah.
Yep. So that's fine. So Profit, if you got employees that are 1099, I mean, I have a lot of people that we just call staff that are 1099. So yeah, that would definitely apply for this. Let's see here. Oh, yeah. All right. So you can find out why there is a giant cockroach crawling up the wall behind me on my Zoom calls now. Interesting. Have no idea what that has to do with this, but sure. Good info. Good info. Family company, husband, wife would like to get my kids involved. Now that's an interesting thing. Brian, Connor's talking about getting, a lot of people don't realize that they can put their kids on payroll and, hey, have your kids do social media posts, something, but do you want to hit on that real quick on how you can hire your kids? That's a huge thing.
Yeah, absolutely. Very easy. When they're younger, I'd say less than 12, 13 years old. I think that, again, not giving tax advice, I think the number is $6,200 is what you can pay, a very, very young, Chris, your 1-year-old, put her on the website, let her, whatever may be. And she's a model. And, that's $6,200. The older kids, I'd say over the age of 12, 13, where they can actually, my 15-year-old, he's responsible for mopping the floor at the office and taking out the trash. And I can get him about $12,400 a year into that. And here's the red flag that I raise for everybody out there. Again, I'm not giving tax advice and I'm not beating up on CPAs because, everybody needs a valued CPA, but it's pay your kids and open up a Roth. Yeah. Again, how about pay your kids and open up a permanent life insurance policy? Because the life insurance policies, again, have so many other benefits that the Roth IRA just does not provide. And when you stack it up side by side, again, we already know how society feels about life insurance, but again, read Chris's whiteboard behind him. And, that's what society doesn't understand about life insurance. It's one of the greatest tax shelters still left out there for us to use. So yes, hire your kids, especially if you're a small business, bring that money back into the home and then put it to work for your children.
I think that was really important what you just said, because you know what, it just kind of hit me. And, I hear that all the time at CPAs, no disrespect to CPAs at all. They know far more about taxes than I do. But again, like they don't know what they don't know. And they don't know about this privatized banking in most cases. And they recommend putting money in a Roth. So the problem I have is probably the same problem you have with that is, let's say you got a 12-year-old and you hire them and you take the money that you pay them and you put it into this Roth IRA. Great. You now just put money in a vehicle that child really can't use to get further ahead in life until 59 and a half. Now I know there's ways to get money out of the Roth, but like just keeping it at face value, like why would you do that? Do you know how many opportunities a 12-year-old, a 15-year-old, a 21-year-old are going to have throughout their lifetime? And almost every single opportunity they're going to have, you know what it's going to require? Money, capital, that tool that we always talk about here at Money School. You're going to need lots of those tools to take advantage of those opportunities. But if those tools are locked in the tool shed and you damn well lost the key and you can't get into it till 59 and a half, well, I don't know. Those tools are doing you no good sitting in that locked up tool shed during your lifetime when it most matters. So I'm so happy you brought that up. I really am. Just going down through, Dave's got 50 employees. Let's see. Henry's got, have more than 2 employees. Okay. Same there. So we got a bunch of people. House flipping. Yep. So if a house flipper is just house flipping and you have no employees, I'll make one promise to you. You will. And if you don't, your hair is going to turn gray really fast. If you're house flipping and doing lots of houses and you're trying to do it all yourself, the time will come. Let's see. Man, lots of questions coming in. Let's see, 12 trash man hourly. Yeah, there you go. And the other cool thing about hiring your kids, like, listen, your kids are going to take your money, whether you hire them or not. So why don't you teach them some good things that they can use in their life? Now, I'm not talking about teach them how to be an employee. Teach them how to be a leader. Teach them how to run a company. Teach them the important things about working on a company. Like, sure, you can hire your kids to take the trash out, kill the cockroach behind you, when you're doing the Zoom, whatever. You can do that, but why not teach them the high level stuff? Like, kids are sponges. Like, can any of you remember back when you were a kid? Life was your oyster. You could do anything you wanted. There was nothing stopping you from obtaining what you wanted. Your imagination was everything. And then life goes on and all of a sudden it kicks you down and all of a sudden that imagination dwindles to almost nothing. But I have to do this. I have to do that because of this. Not I want to. Teach your kids how to create instead of conform. And I think you can do that while paying them, helping them, and also teaching them a lot about money and just life in doing the process. So let's see. Got a bunch of, we hit a nerve there because we got some people that are typing some stuff in here. This is awesome. Started 3 different businesses before I walked the stage for my diploma. Holy smokes. So what, diplomas, that deal, what, like 17 years old? I think that's profit there. Started 3 different businesses before I walked the stage for my diploma. So yeah, 18 maybe, I don't know. That's freaking awesome. Let's see, will paying kids be part of the training this weekend? Absolutely. I'm glad you mentioned that, Jamar. We actually have a whole section that we're doing, a full 30-minute training on exactly that topic. That's kind of why we brought it up. Let's see, would have sucked. Holy smokes, these chats. Didn't get a lot of guidance when I was young, still, yeah. And exactly, a lot of the stuff that we got to learn, we don't learn until it's too late. And that's just the fact of life. Let's see. Eve said, my blood pressure was unnaturally high. Oh, okay. So just more stuff about hers. No big deal there. Yeah. So you can read that one, Brian. That's probably something you can address. Gene said, I already have a whole life policy on both my boys. Yeah, attaboy, Gene, go get them. All right. Let's see. Michael, what's the best way to get started in flipping hours? What's the best way to get started in flipping hours? If I'm reading it right, Michael, it's easy. Stop working for money and start making your money work for you. And I'll just leave it at that. Brian, you want to hit on that one? What's the best way to get to, start flipping hours if I'm answering it right?
Yeah, I was a little bit confused with the question. Is that flipping hours is that one of your terms?
I've never used that one. No, that's a new one.
Okay. Yeah, I'm not sure what he means there. Flipping houses. Yeah.
Oh, flipping houses. Oh, best way to get started on flipping houses? Goodness gracious. There's stuff everywhere. I will tell you here, Michael, here's the biggest advice I can get, or I can give you, being somebody that's flipped, I flipped 200 and what are we at? 200, over 260 houses. It's like 267. The number one thing that flippers make the mistake of is they overpay for the house. They get so excited about the aspect of flipping the house that they forget the most important thing about any investment, including real estate 101. The money is made on the buy, not the sell. So if you just take your time, Michael, and you focus on learning as much as you can about how to buy real estate the right way. Forget about all the other stuff, Michael. Forget about everything else. Focus all of your attention on how to buy the properties. And you know who some of the best teachers are for that? Wholesalers. People like Justin Colby, Chris Rude, people that know how to buy the property way lower than anyone else can get it, because they understand that. That's what you need to learn. Forget about like demo and construction and what colors should I do, and should I do a farmhouse or should I do a contemporary? Like, none of that matters. If you overpaid for the house, you will always lose money, and that's the biggest advice I can give on flipping houses. Let's see, and also to start your privatized banking so that you can fund your own rehab instead of paying people like me 12 to 15% for us to give you the money to do that. That might be another one. Let's see. Anonymous said, is the interest to be paid on a whole life policy shown somewhere on the application? No, I don't think so, Anonymous. The interest, yeah, it's not. I don't think anywhere on the application it's shown. The contract would show it. All right, let's see. So we've got the information up on the 2-day event. We posted that in. That's this weekend. We put Brian's information there. I thought, wasn't there another question here? Let's see, hiring kids, and isn't it child labor abuse or whatever it's called? Wouldn't just cost of raising them be tax deductible? Well, I don't know, Jose. You can't tax deduct all the money you spend on your kids to raise them, can you? Look at your face, Brian. Oh man, you got to watch this recording and just see that. Yeah, I don't think the cost that you incur in raising your children is tax deductible, but hiring them is definitely not child labor unless you make it child labor. I mean, hiring them is teaching them how to be self-sufficient and how to create the financial future they want if you do it right. If you don't do it right and you got the wrong intentions or self-serving kind of intentions for hiring your children, I would say that probably is abuse, and you probably shouldn't do that. Oh my goodness gracious. See, these trainings go all sorts of different ways. Let's see. I'm just trying to see what else there is. So we've got the trainings on there. I got to put Brian's information back up because we got someone asking for that. So there's Brian's info. So if you guys want to schedule a time with Brian to learn about any of these executive strategies, the asset care. And Brian, you're joining us this weekend for the 2-day as well.
Yes, I am. Looking forward to it.
We're doing a really cool bonus session. First time. Well, this is only the second one of these 2-day advanced IBC trainings we've done, but Brian's going to join us for a bonus session on Saturday. He's got something really fun for all of you. So any of you that join us, and for the first time, or second time actually, the bonus will actually be recorded, and anyone that signs up for the event will get the bonus. And I did say how expensive the event was, right? Everybody got that? It's $50. So it's a real wallet drainer, but I want everybody to realize we don't charge $50 because we're trying to profit from that. And if any of you think we are, then I'll just, come to the event and see why we do it. The $50 that you spend is so you actually take it serious. There is something literally statistically proven that when people put their time and their money into something, they get a lot more out of it. I don't know why. I mean, listen, if everybody would get the same thing out of a training, if it were free, I'd do all of them free like you did today. But unfortunately, when you put your dollars and your time in, you take so much more out of it. I think just because that's just what I think we've been taught to do that. Like when we pay for something, we value it more than we do things for free. Love is free, but we don't give that as much value as we do the expensive car we just bought. And that's probably not the right analogy, but you get the drift. I don't know. Weird.
Yeah, your wife will not like that analogy, Chris.
Yeah, so please don't anyone repeat that to my wife. She's not on here. I'm eating my words, just like earlier when I mentioned something and it kind of went political. I was eating my words there because I hate talking politics, just hate it. Let's see. What are the times for the 2-day? Here, actually, let me just do it this way. Here's the 2-day, folks. This is the link that you all will see when you go to that link we keep posting. So right here, and here's the schedule. And the schedule has changed. So don't look at the topics. We are literally revamping it. Even as early as this morning, we were doing it. So day 1 is this Saturday from 10 to 2:30, but actually we're going 10 to 3:30 with the bonus. And then day 2, Sunday, this weekend, it's 10 to 2:30. We don't have a bonus session. You're right. Nobody appreciates free, which is kind of backwards. But, there's just so much stuff. I mean, we got testimonials. You can go on this link and check all that stuff out. But the last one we did was the first one ever, and it was just a huge hit. We had well over 200. How do I stop this? Well over 200 people on the training. And, one of the things we did, folks, and we do this a lot, is we asked everybody for their feedback of the event. And a lot of people gave us, great feedback, but some people gave us constructive criticism, which we love. And a lot of people are like, oh, I want to just tell them it was great, but I really thought they should have done this. Please, be a jerk. Tell us what you didn't like, because then we can fix that. And people did. They didn't say, oh, you guys were jerks, but they said, oh, I thought it was going to have this, or I thought you were going to cover that. And you know what we did? Shauna spent, I don't know, probably 8 hours going through everybody's feedback. And we literally came up with an FAQ fact sheet of what we wanted to hit for this one. And we addressed every single thing. Andrew has been hard at work, and Andrew's on here, been hard at work putting this whole training together. And just so everybody knows, there's a ton of new stuff that we've never done. Matter of fact, I'm worried because I've never even seen these trainings that we're going to be doing this weekend. And I'll probably have, Andrew, about 2 hours to review them and get them ready. That's how we roll. That's how we roll. Yes, the tax guy from Florida will be on. Solomon will be on talking about 1041 tax reporting, private foundations, and complex trusts. He will have an entire hour-long session on there. So yeah, so those are the answers to those questions. Let's see. Can you Michael was asking how he follows us on social media. So Michael, here is my name. So you can just go there. But if you want to follow me on social media, every one of my social media, from Facebook to Instagram to TikTok to YouTube, is all the same thing. It's at the Chris Naugle. So there you go. I just put it in there for you, Michael. YouTube is my biggest thing that I put. I mean, if you want to laugh and get kind of daily updates and things, Instagram, I put stories up every single day, and some of them will probably have you on the floor laughing because we do some pretty stupid shit. Excuse my language, but I don't know. There's just some days you wake up and you're just like, I'm just going to be an ass today, and I'm just go on. You just be an ass. That's the beauty of social media, especially stories, because it's there and then it's gone. And then I don't have to worry about it anymore. So we do some fun stuff, but we always try to provide value. And I was taught by a mentor a long time ago that one of the most important things you can do is give the best stuff away for free, which is what Brian does, which is what I do. It's what my entire team does. We always give the best stuff away for free. And Brian, just kind of as a final thing, I got this neat little thing I want to go through and talk about kind of, an employer standpoint. What would be the perfect vehicle for an employer? And I just want to hit on a few of these things. Employers, I think, are focused on several points and several things in their business, when it comes to employees. Number one, retention. Especially right now, I think retention's massive because, let's face it, people don't really have to work now. I mean, if any of you have been to a Subway or a fast food restaurant or your regular restaurant or anywhere like Home Depot or Lowe's, and it just goes on and on and on, you've noticed that there's a wee little bit of a labor shortage right now. It's because people don't want to work. So employers are finding very unique ways to retain employees. And a lot of employees want more. And that's the only thing they want is more. So that's a key thing. Also, employers want performance. They want their key employees, to basically have, they want them to perform. They want them to do things. And, there's ways to do that. So I just want you to remember that they want them to perform. So how do you get somebody to perform to unusual levels or levels people don't think? How did Steve Jobs get people to perform at the levels he did when things were said to be impossible? A lot of times It's through different incentives, different bonuses, and it doesn't always have to be monetary. They've done studies where the monetary bonus only gets an employee so far. Employees want to be part of something bigger than them. They want to build something that's going to be remembered when they're gone. That is more powerful, and that's what Steve Jobs used. I think he had a word for it. If anyone reads Steve Jobs' book, what was that thing that they said he did? Anyone that does that, I'll give you one of those free shirts that haters need hugs. So what was that thing that Steve Jobs did? And he was known well for this. There was a name for it. And I want to see if anyone knows that from the book. Protection. A lot of employers want to make sure that their employees, as well as themselves, are protected. And not only that, they want to make sure that their employees have proper income. Now, I know you don't think your employer thinks that, but employers actually do want their employees to make a good income. But a lot of times the income is tied to the performance. See where that comes in. And all of these different things, okay? All of these different things I just mentioned. They also want tax deductions, okay? They want all this stuff, but there's not really one place where you can get all that, but there actually is. Because what I just read you was literally every single thing from this page here, and there's more, there's a whole nother page, which I'm not going to bore you with it, but this is all stuff that goes back to non-qualified deferred compensation plans, because you can get all of those things and you can reward your employees, your key employees, not the employees that are sitting on the couch doing nothing that you don't want there anyway. You can reward just the ones that are really driving your business, and you can help them get where they want to be through this vehicle. So we're going to be talking about that a little bit this weekend as well. And if you have additional questions, you can ask Brian. So Brian, let's put your link up here one more time and make sure that everybody has that. So there's how, whoops, no, that's the this weekend's, sorry about that. That's this weekend's event. And then I'll put Brian's link up here in just a second. Here we go. So if anyone wants to book a call with Brian to talk about any of these things that we went over in today's training, there it is. And if any of you want to join us this weekend, Saturday and Sunday, 10 till 2:30, and then the bonus session Saturday with Brian, then click and sign up there. And I don't know, Brian, anything else in closing you want to say?
No, I think you knocked it off the chart again right there. Yeah, you know what I find. Here's one thing I would say to the business owners. Okay, you want tax deductions, and you want to keep more of the money that you make. So don't go put qualified retirement plans in place in your business that actually do the opposite for your employees than really what you're looking to do. And it's just remarkable the amount of businesses all over this great country of ours that do that exact same thing. So, you know, Chris was talking about, you know, what your employees want or what people want out of their jobs and everything else. And, you know, it's the value, not necessarily, you know, the extra 2% or 3% raise every year. So
100%. And you know, it's funny, growing up, I always thought it was always about the Benjamins, you know, the employees worked harder because they made more money. And I would find that the employees worked harder because they felt like they were part of a culture. They felt like they were part of something bigger than them. And that is something, that's how I built my skateboard shops. I mean, it's a skateboard and snowboard shop. I mean, it's like literally minimum wage. And I got people to do the unthinkable things, work extra hours, come in for free on weekends to do events, not because of money, because we were building something that we were all passionate about. So when any of you business owners are thinking about like building your business, start with the culture and start with how your employees want to help you build this, but make them part of it. Don't alienate them from what your dreams are. Share your dreams with them, share your goals, share where the company's going, and make them part of that growth. Give them incentives that if they stick with you to grow this, they're going to make X or they're going to be part of Y, you know, whatever it is, and watch your business take off. You know, there's a lot of businesses out there struggling to keep employees. Well, I think a lot of it, there's a huge disconnect between the management and the employees. The employees just feel like they're there to punch a clock and trade hours for dollars. Those employees will be gone tomorrow, every time. When those employees feel like they're not just punching a clock and trading hours for dollars, they feel like they're building something. they will stick around for the long haul. And again, in closing, I'm just going to say this one last thing again, because it is the most profound quote that I've ever heard from Will Rogers. The biggest problem in America is not what people don't know. The biggest problem in America is what people think they know that just ain't so. Be careful who you folks surround yourself with. If somebody tells you you can't do something, if they're keeping you down, put them in timeout and find people that will help you get to that point where you can live your perfect day every day. I hope you guys all enjoyed this. Brian, I know this was fantastic. Thank you for your time. And any of you that want to join us, 4:30 happy hour, bring your cocktail, your tea, your coffee, or your water, and your questions. And we'll be there at 4:30 for you to have a bunch of fun. So thanks everybody for joining us for another wealth webinar series. We'll see you on the next one.